All right, let's get right into it. The data we're seeing from March 2026 isn't just a warning sign. It indicates a fundamental, and I mean violent, breakdown in the actual mechanics of global trade. The entire system is flashing bright red. And here it is, the single most jaw-dropping data point of the day. A 93% collapse in commercial shipping through the Strait of Hormuz. You have to understand, we're talking about the choke point for over 20% of the entire world's oil supply, and it has been effectively shut down. And to really wrap your head around the gravity of the situation, you have to look at this assessment from the Global Strategic Risk Report. This isn't just a market correction or some regional dispute. The data frames this as a violent, disorderly global transition, the kind of thing the world hasn't seen since the 1940s. So, let's zero in on that Hormuz collapse. Because that number, that 93%, it's not just a statistic on a screen. No, it represents the actual physical severing of a critical artery in the global economy. And when you dig into the raw intelligence from Lloyd's list, it is just staggering. I mean, think about this. Transits are down from a baseline of over 1,200 vessels to just 77. At one point, you had over 200 tankers just sitting there, completely stranded. And with 16 vessels being directly attacked, the maritime insurance market, the thing that makes all of this possible, it's just gone. It has collapsed. You simply can't price this level of risk anymore. Okay, now it's time to pull back the lens and look at the bigger picture, because the Hormuz crisis isn't happening in a vacuum, not even close. It's really just a symptom of a much wider systemic geopolitical fracture. We are living in a world of simultaneous, interconnected conflicts. And this table here, built from data from the Council on Foreign Relations and Crisis Group, it shows you exactly how these shocks are all linked together. You've got an Iran-US conflict, boom, global oil price shock. The war in Ukraine drags on. That hits grain and fertilizer supplies. Escalation in the Levant, that drives capital to gold and the dollar. Then you have drone warfare in Africa creating a supply shock for the critical minerals we need for our tech. And get this, even domestic polarization in the US is now considered a tier 1 risk, messing with global capital flows. You see, each crisis just feeds the next one. So here's the bottom line. How does all this geopolitical chaos actually hit our wallets? Well, the result is something called a structural stagflation. Now, that's a really nasty combination of persistently high inflation plus low or even stagnant economic growth. And it's forcing the world's central banks into what is basically an impossible corner. And this slide just lays out the trap perfectly. Over in the US, the Federal Reserve, they wanted to cut interest rates. But now, they're forced to hold them high, and they're even signaling they might have to start hiking again because inflation just won't die. Meanwhile, over in Europe, the ECB is in an even worse spot. They're stuck holding rates high in a low-growth economy because their reliance on energy imports means inflation is absolutely raging. Any hope of an easy money cycle is completely off the table. So this new reality has triggered what can only be described as a radical reassessment of risk across the board, forcing a huge shift in investment strategy. Now, speaking of which, it's crucial at this point to state that the information, comments, and recommendations here are not within the scope of investment advisory, and that any person acting on this information does so at their own risk. All right, with that out of the way, let's look at how the markets are actually responding to all this. Because let me tell you, the old playbooks, they're being thrown right out the window. We're witnessing a great rotation into hard assets, as big players like central banks seek a true safe haven. And that traditional relationship between the dollar and precious metals, it is completely broken down. I mean, just look at the divergence in these price targets for gold from the big institutions. It's absolutely wild. You've got Morgan Stanley with a bearish call at 4,600, while JP Morgan and UBS see it going north of $6,000, maybe even $7,000. This isn't just about hedging against inflation anymore. This is pricing in a massive de-dollarization trend where the world's central banks are aggressively buying physical gold. Now, we have to talk about silver, because its story is, in some ways, even more fascinating. The whole thesis boils down to one key concept: a structural supply deficit. It means that every single year, the world demands up to 300 million more ounces of silver than we can possibly mine or recycle. Why? Because silver has this incredible dual role. It's a monetary metal, yeah, like gold, but it's also an absolutely critical, non-negotiable ingredient for AI data centers, solar panels, and pretty much all modern electronics. And what this creates is one of the most asymmetric risk-reward profiles you can find anywhere. So what does that mean? Well, on the downside, sure, if we get a huge global recession, industrial demand falls, and as JP Morgan notes, the price could go down. But the potential upside? It is explosive. Bank of America's hyper bull case sees silver breaking past $300 an ounce. The theory is that this massive physical deficit will eventually just break the paper market, triggering an unbelievable short squeeze. So, given all this chaos, this new paradigm of what really feels like a permanent crisis, how is the smart money, the institutional capital, adapting? We're looking at the new investor playbook right here. And believe me, the main goal is changing fast. And this data from Goldman Sachs, wow, it really tells the story. You can see capital is just pouring out of traditional fixed income. And where is it going? A huge chunk is flowing into active ETFs, where managers can react quickly to all this volatility. We're also seeing a lot of money go into so-called defined outcome strategies. These use complex derivatives to basically build a safety net under their investments, trying to protect against the absolute worst-case scenarios from all these geopolitical shocks.
And really, this all boils down to one core takeaway, which this quote just nails perfectly. When you get this convergence of intense conflict, energy scarcity, and technological disruption all at once, the simple truth is that nowhere is truly safe for capital anymore. The primary job for investors is shifting away from the simple pursuit of growth and toward the urgent preservation of capital.
Which leaves us with this one last provocative question. In this new era of permanent crisis, is simply preserving your capital the new form of growth? Think about that. If this data-driven briefing provided you with some value, please help others navigate the 2026 geopolitical inflection. Like this analysis, share it, and be sure to subscribe to @NextGenInvest Global.